Hello, everybody, and welcome back. Today, my guest is Alfredo Mordezki. Alfredo is the head of Latin American Fixed Income at Santander Asset Management. And today, we want to discuss recent developments in the South American financial market. Welcome, Alfredo.
Thank you very much. Thank you for the invitation, Thomas. I'm very glad to be here with your audience.
Alfredo, South America did not look very good during the COVID-19 crisis so far. What are the arguments for considering Latin America as an investment story currently?
That's a good question, Thomas. If you look at the headlines, I would agree that it doesn't look well. But what are the headlines about? The headlines are about infections, about the rate of vaccination. And I would agree that Latin America is somehow lagging on the managing of the pandemic, as we were expected. It doesn't surprise us because there's a lot of informal labor. There's a lot of natural conditions that make it a bit harder to do the social distance, to implement a lot of things that maybe were much easier to do in Europe or the US. Now, besides that, if you want to look at expected return, you want to look at mobility, you want to look, which is highly correlated with growth. So even if the rates of infections were a bit less favorable than the rest of even emerging markets, still we see that mobility took a considerable return in the last few months. After this low at March 20, when the strong lockdowns started all over the world. So mobility is back. You have a good story behind. Commodity prices, as everybody knows, are very important for Latin America. Commodity prices have recovered significantly. So you have a few reasons to go back. I would say, last but not least, international reserves. As you know, during the 80s, you had the currency crisis, the balance of payments crisis. So today you have the region in a very, very strong foothold from the point of view of international reserves, with a few exceptions, namely Argentina, Ecuador, Venezuela, but the rest of the continent is very, very strong.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now.
How has COVID-19 affected the Latin American bond market so far, especially in terms of credit quality, yields, but also default rates?
Well, of course, in March, it was a bit of a shock for every credit market in the world, right? People need to reassess and change the point of view we were looking at credits. For instance, if you look at credit in a standalone basis, in a normal situation, you look at income, you look at the business, how the business is going. You look at leverage, you look at the amount of debt compared to the income. When you have this kind of shocks, you have to look at liquidity. So you have to stop your analysis and then put your highlight on liquidity. And companies were very liquid, most of them. And the good news is that in our sectors, the companies that we are mostly involved are very strong companies, exporters, companies that really, I wouldn't say benefit, but survive very, very, very well this liquidity shock that we had from March 20. Of course, this second quarter of 2020 was very bad for everyone, utilities. Everyone really showed in their results this effect, but recovery was very strong, which is, very good for us. Of course, there are companies that didn't go well. But these are not really represented in the credit markets. We don't have hairdressers, we don't have local gyms, we don't have, these companies did badly all over the world. And in some countries, they were protected by the governments, in some countries not. But these are not part of our indices, not part of our markets. So usually we have exporters, we have sound companies that did pretty well, I would say. In terms of default rates, well, that's very interesting. Because in March, if you saw the sell-off of the market, you could imply a default rate of around 12 to 13% of the stock of high-yield bonds, which really was like very unusual, right? At the end, we had 4%. And this 4% is double the previous years, which was below 2. And what explained this 4%? Well, I would say 2%, half of this default rate, comes from airlines. So we had defaults on airlines. Why? Because we had the airlines landed for, I would say, most of the year. And so, as you know, I mean, airlines are companies that usually are quite leveraged plays on growth and on the ability to go on as a business concern. And as a result, I mean, they were affected. So in our case, we didn't have any exposure to the sector, which is not big in the indices as well. But yes, this sector was truly badly affected in Mexico, in Brazil, in Chile, and in Colombia. We had defaults coming from all these countries. Then just a very tiny portion came from lodging and leisure. We have from Mexico and Chile, two small companies that already were facing some difficulties. So apart from the airline sectors that had this big liquidity shock, we didn't have a lot of surprises. It was mostly like the usual suspects that got caught in the liquidity shock.
So the inflation discussion is back in financial markets, and with the inflation, obviously interest rates. So we've seen first interest rate hikes in the US now. What is the situation in Latin America, and how would further interest rate hikes affect the attractiveness of Latin American bonds?
I have to say, if I start from the second part of the question, central banks in Latin America have been very, very active. In fact, they have been unwinding the dovish monetary policy at a much faster rate than the US. And you have now, like the central bank in Brazil, very, very strong. We are expecting even close to 7% interest rates at the end of the year, coming from 2%. So they have been really very, very active in fighting every sign of inflation. And we know that this can come from some disruptions in supply chain. So it may be something that is not that is temporary. But because these economies have more indexation than the US and maybe less competition as well, then central banks have to be much more proactive. And this is what they have been doing. They have been really advancing interest rate hikes. And we expect that from Mexico, from Chile, and probably Peru as well. But okay, I'm going now for the first part of the question. What's the effect in the market? We had some volatility. We did have, yeah, that's very true. As every market, especially the investment grade side, which has a lower duration than the high yield counterpart. But we have to say that the difference in investment grade with the US counterpart is that we carry around 100 to 120 basis points of extra spread. And that means we have a bit more cushion. So we will have the volatility coming from the treasury as much as every investment grade sub-market. But at the end of this volatility, returns will be impacted by a much higher spread to treasuries that provide a cushion for this volatility and an extra return at the end of the year. So that's why I think that especially for the investment grade part of the portfolio, I think Latin America is a very efficient contributor on a portfolio of investment grade securities.
In the eyes of many investors, Latin America is still primarily a commodities region. To what extent is this also reflected in your portfolio, or do you find also value in other industries?
And investors are right. There is still, it's a region that has a lot of involvement with commodities, of course, but much beyond oil. I mean, it used to be a region much more aligned with oil. Now it's much more metals. And it's very important to dig further on these concepts and understand what commodities in which countries and which companies. This is important because you will have a lot of different stories around copper, around zinc, around, different metals, cobalt, nickel, lithium, which is very, very significant now for the electrification of transport. So it's a story that still has a relationship with commodities, but I would really encourage investors to go beyond, the usual suspects and dig a bit further on the different stories, because there are very interesting stories also about soybeans and all commodities related to, food commodities, cereals, which are very significant, but very different from market to market. Sugar may also be a comeback story that is worth looking at. In Brazil is the second producer in the world of sugar, and prices have been very low for a long, long time, and now we are like a 7-year high. So it's worth revisiting this story. And apart from commodities, what do we have? We have banks. Banks are very strong, very conservative, very well capitalized, and very profitable. Because remember, interest rates are higher, so this difficulties that European banks have on trying to be profitable in an environment of negative rates, you don't find it in Latin America. So you have strong capitalizations, strong profitability, and a very conservative stand. So that makes the banks a very desirable destination for investments. And more if you think that interest rates are going up. You will see that margins, net interest margins will be coming up as well.
What have been the major changes you have done to your own portfolio since earlier this year, especially in terms of country and segment allocation, but also in terms of quality and maturity?
Yes, well, I would say I would highlight a couple of changes. As you know, this year has been quite populated of political headlines. So we found at the beginning of the year that pricing was not reflecting the headline volatility that we could expect. So one thing that we did is we lower our exposure to these companies that we really like. Good companies, very sound businesses, but were almost priced to perfection. So we saw utilities, banks in Chile and Peru, where we expected some political related volatility to come in, which at the end pretty much pay off. But most of the volatility was very, very short-lived. So we are still waiting for a better entry point to these companies. We really like them. We have zero problem with the companies themselves. It's just a matter of pricing. So we did that in Peru and Chile. And regarding duration, what we did is at one moment in time, we really took the conclusion that the movement in the treasury has been too fast. Even if the direction of travel was correct, we were going from 0.70 to 170 in 6 months. And it was a bit like there was only one opinion in town, and we thought that we were ready for a pause. So in Latin America, there are very strong companies that are able to issue in the 30-year space. And these bonds have become very, very cheap as a consequence of the rise on treasury yields. So what we did is we loaded a bit of the long end that we were very much underweight at the beginning of the year to try to pick up from these good companies, a better performance.
So this was Alfredo Mordezki from Santander Asset Management. Thank you very much, Alfredo, for being with us today and sharing your valuable insights into a Latin American bond market.
Thank you, Thomas, for the opportunity. Thank you. Anytime.